Hello, my name is Amit Trivedi, and we are going to discuss the very critical and important aspect of the financial services industry, which is regulation and consumer protection. Now, what we are going to cover in the session today would start with the basic question why regulators are needed. From why we'll move on to the overall structure of regulatory system in India by defining the role of each one. There are 4 finance sector regulators that all of us know about: Reserve Bank of India, Security and Exchange Board of India, Insurance Regulatory and Development Authority of India, and Pension Fund Regulatory and Development Authority of India. These 4 regulators, what functions they have to play, what role they play in the system. Now, their role is one part, but eventually for the main objective for which they play these roles is all about the rights of the consumers. At the helm, it is about the protection of the consumer rights. Now, that's insofar as the regulation is concerned, but there are also many unregulated entities. What the consumer needs to keep in mind to safeguard one's own interests. Once you understand the regulatory landscape, it becomes relatively easier to select appropriate intermediaries to deal with. And lastly, we'll talk about a major protection that is available to the deposit holders within the banking system. Now, let's start with the first question. Why are regulators needed? This small diagram tries to graphically represent the overall economic system. And there, as you can see, there is a company which is into, because we are talking about financial sector, let's say a financial services company. This company could be a bank, it could be an insurance company, it could be a mutual fund manager or a portfolio manager, it could be a stockbroker, whatever the entity. Generally, for a large number of individual consumers in particular, the entity would be significantly large player in comparison to the various consumers, and these small bubbles represent those consumers. Now, size is one part. The second part is, while the professional company, the entity, those entities may come together and form their own association. The consumers are generally quite diverse and they are spread across the country. And to that extent, they are small, number one, and two, they do not have a unified voice. In such a case, the scales are tilted in favor of the industry. And in this equation, the regulator and the regulations, they aim to provide a balance between the two, so that while the voice of the smaller consumers is heard and proper actions are taken, it is not done at the cost of the larger players. And that's why all the regulators typically have 2 main objectives. One is the protection of consumer rights, consumer interests, and number 2, regulated growth of the industry. So, consumers' rights and consumers' interests are primary. secondary is the growth of the industry in a regulated manner. The moment regulators play this role, the trust of the consumers grows in the system, the industry, and because of that, the investors feel comfortable to invest more money, buy insurance policies, take loans, open bank accounts, put their retirement money with these players. At the bottom of this entire structure lies a very strong foundation known as trust. And the presence of regulators is aimed at strengthening this platform called trust. With that primary objective, the regulations span across various areas, primarily because the players are small, they may not have the expertise. The regulators aim to promote financial literacy, and that tends to become one of the objectives. They also, while promoting literacy, need to protect the consumer from any sort of manipulation or exploitation. Even after enough number of regulations, even after putting those boundaries, even after providing literacy, there is a possibility that cannot be ruled out, that at some stage there could be some consumer complaints, there may be some consumer service issues. And in such case, regulators also provide a complaint redress mechanism, a defined system of how the complaints would be addressed, what would be the escalation level, and what are the timelines for resolution. It's also important that the consumers are able to take informed decisions. Am I borrowing at a certain rate? Am I borrowing at a higher rate or a lower rate for a reason? Is my deposit with a bank safe? Is my investment in a mutual fund safe or risky? What is the level of risk? These questions must be answered, and for which the regulations mandate certain disclosures at certain periodicity, so that correct information, relevant information, timely availability of that information is ensured. Correct, relevant, and timely. The industry also must engage in business practices which go beyond regulation and also pass the test of ethical question. Are they following ethical practices or not? And finally, while the information disclosure is something that we talked about, the advertisements that the companies issue also must be proper, and that proper means the advertisements should not be misleading, they should not be deceptive in any manner. While we talked about protection of consumer, we also said it is also about regulated growth of the industry, and from that point of view, regulation also provide legitimacy to the existence of these market participants, market intermediaries, those businesses. A bank becomes legitimate only when it is registered with or licensed by the Reserve Bank of India. A company can launch an investment scheme only if it is registered with SEBI, the Securities Markets Regulator. A company can sell insurance product to the consumers only if one comes under the regulatory purview of IRDAI. That gives legitimacy to the businesses as well. And at the same time, it also gives the freedom to conduct business within those boundaries. And those boundaries are the regulations. As we mentioned in the introduction, there are 4 finance market regulators. And these 4 finance market regulators come under the purview of Department of Financial Services, which comes under the Ministry of Finance. And what are these regulators? First is the banking sector regulator, Reserve Bank of India. Then the securities market regulator, Securities and Exchange Board of India. Then comes the insurance regulator, IRDAI, or Insurance Regulatory and Development Authority of India. And finally, the regulator of pension funds, Pension Fund Regulatory and Development Authority of India, PFRDA. At one point in time, we had 5 regulators in the financial market. There was some entity known as Forward Markets Commission, which was regulating the derivatives market on the commodities side, the commodities derivatives. But a few years back, that has been merged with SEBI. So now FMC is now part of SEBI, and to that extent we've got 4 finance market regulators. Now let's look at the objectives of each one, the role of each one. To begin with, the banking sector regulator, RBI, has a multifold role to play. First of all, RBI is the monetary authority of India, which means RBI handles the monetary policy. And what is a monetary policy about? It's about availability of credit or money and the cost of borrowing. It can impact the economy's growth. It can impact the inflation in the economy. So that's a very critically important role. At the same time, it also plays the role of a regulator of the entire financial system and the supervisor of the entire financial system. In financial system, namely the banks, housing finance companies, non-bank finance companies, the payment wallets, the electronic wallets, all these entities come under the purview of Reserve Bank of India as far as the regulations and supervisory regime is concerned. RBI also is responsible for issuance of currency notes. Just take any currency note and you would see that the currency note bears the signature of Governor of Reserve Bank of India. And it says that I promise to pay the bearer of this currency, etc., etc. That I promise to pay, that line is undersigned by the Governor of Reserve Bank of India. Essentially, Reserve Bank of India controls the supply of currency in the country, but it is the issuer of currency as well. How much is the foreign exchange reserve within our country? How much forex can go out, how much can it come in? At one point in time, RBI used to control that. Today they regulate, monitor and manage. the foreign exchange within the country. This has a major implication on the exchange rates between the Indian rupee and various currencies of the world. If there is an inflow of foreign currency into the Indian markets, the money coming from outside would fund the growth of the economy, but at the same time, it will also strengthen the Indian rupee. However, if more money keeps going out, then that would mean that we'll have to keep generating more and more within the country to fund that growth which goes out, fund that money flow which goes out. And it is possible that this outflow may result in depreciation of the value of Indian rupee. And from that point of view, apart from managing foreign exchange, RBI's actions can also impact the foreign exchange rate between Indian rupee and the other currencies. RBI also plays a developmental role on, in line with the government's broader objectives to help the economy's growth, economy's development. Some of the policies that the government wants to implement, because RBI eventually is the regulator of banking system, and banking system can channelize the flow of money, RBI can play a huge developmental role in channelizing the money at the right places at the right time. And finally, all the banks and the governments have their account with RBI. RBI is the banker to the bankers, RBI is the banker to the governments. And this way, if you see, the role of RBI is massive. The impact is even bigger. The second regulator, SEBI, aims to regulate the activities in securities markets. Now, securities markets play a massive role in channelizing the household savings and putting those money into the hands of industry, the corporates, so that the money that is lying at home is available for growth of business, and at the same time, the households who are investing that money can participate in the growth of those businesses and in turn increase their money's earning potential. While that is one part which is regulating the activities of secondary market or securities markets, it is also important to protect the investor. And this protection, as we discussed a little while back, increases the level of trust, which in process increases the money coming into the securities markets. Prevention of investor interest goes hand in hand with prevention of malpractices. And finally, for all the intermediaries involved in the securities markets, apart from the regulations, SEBI also issues codes of conduct, which really is broader in nature and it goes beyond regulations, and that touches upon the ethical aspects of conducting business. The players in the securities markets can be broken down into three parts, and we can call them the three eyes of these securities markets: issuers of securities, investors who buy those securities, and the intermediaries who intermediate between the issuers and the investors. Now, for each of the three eyes, SEBI may have different objectives. First of all, as far as the issuers are concerned, they need a fair marketplace to raise money. What's a fair marketplace? A fair marketplace means there are equal opportunities without biases, without prejudices. They should be able to raise money at a reasonably low cost and reasonably high efficiency. That's a fair marketplace to raise money. Transaction costs are low, operations are efficient, the scope of errors and malpractices is brought down to the minimum, and different players get equivalent opportunity. The investors, they need accurate information in order to take informed decision. And that's why the issuers and intermediaries are mandated to provide timely information, relevant information, and correct information. So the regulations are framed keeping this requirement in mind, keeping this objective in mind. And what do the intermediaries need? The intermediaries need a competitive professional environment. So first of all, they get legitimacy by being registered with SEBI or licensed by SEBI or regulated by SEBI, whatever the case may be. They also get a competitive environment which by itself, as Adam Smith called it, the invisible hand. The competitive forces of the market bring out a lot of efficiencies and bring down the costs. But the environment also must be fair for the intermediaries. And these are the primary objectives with respect to each individual type of entity in the marketplace. From their role and objective, if we go to their respective functions, the functions can be divided into three categories. The first one is the protective, second is developmental, and third is regulatory. Incidentally, all three are interlinked to some extent, but the primary reason why these functions exist are protective in nature, developmental in nature, or regulatory in nature. Let's look at various functions that come under each of these categories. First of all, price rigging. What is that? Price rigging means anything that is traded in the securities market, the market price of that security, be it a share, be it a bond, be it a debenture, or even the derivatives contracts, whatever be the case, the market price of that security should be determined by the market forces and not influenced by a small number of people who, by manipulating the prices, can dupe the retail small investors and extract some money out of it. Price rigging means artificially moving the prices in a direction, either up or down, in order to lure investors or cheat them. That's a very important role from ensuring investor protection. The second is insider trading. The share prices in particular of companies move in line with what the company's future is likely to be. And that future may be shaped or at least influenced by the decisions taken by the managers of the company or the board of directors. Because the board of directors and the managers are taking those decisions, they have those inputs available ahead of general public. If they do their transaction on the basis of that information advantage that they possess, that's unfair to somebody who does not have easy access to that information. And that's why there are norms. The insiders have to follow a stronger, more rigorous process. They also may be restricted to take certain actions. For example, before or after a certain decision, there could be a gap during which the company's directors or people who have access to that information are not allowed to transact in that security. In fact, the regulation, includes the family members of the people who have access to information. In other words, all should be able to transact in that security, and by all it means whether somebody is an insider with access to information, somebody who is outsider who has got no access to information, they should have a fair chance to evaluate the information. Can somebody commit a fraud? Can somebody engage into unfair practices and take undue advantage? Well, there are regulations. There is a specific regulation called Prevention of Fraudulent and Unfair Trade Practices that covers insider trading also as part of it. Price rigging also comes under that. Various other fraudulent practices are also covered under that broad regulation. Each entity involved in securities markets must highlight the investor grievance redress mechanism, the escalation matrix on their respective websites. That must be disclosed upfront. So as a consumer, let's say somebody having an account with a stockbroking firm, somebody who's got an investment folio with a mutual fund, I should have the ability to access the information about what to do in case of a complaint. What is the process? The intermediaries are also mandated by regulation to disclose the timeline within which they'll resolve these complaints. And if that doesn't happen, then one can always approach the regulator, that is SEBI. Whatever the case, there are regulations for prevention of certain irregularities, but after that if something takes place, then there are severe punitive actions. And there are cases where people have been barred from accessing securities markets for periods as long as 5 years, 10 years. There are cases where the unfair profits that somebody has made, illegal profits that somebody has made out of any of these practices, that profit is disgorged and distributed back to the people who lost. And there are real cases which have taken place in last 20-25 years. The second activity is a second category of functions is the developmental function. In order to ensure that the intermediaries dealing with the consumer are possessing certain basic minimum skills, SEBI has mandated certification requirements, and these certifications are mandatory to enter the field, but these are not one-time certificates. They have a validity for a certain period, and before that period gets over, these certificates need to be renewed. There are different ways of renewal. In certain cases, there are exams to be written, and in certain cases, certain training programs to be attended. But this is a certification which is a combination of initially somebody writing the exam and then continuous learning process, which means the skills of the intermediary need to be upgraded on a regular basis. So that's the developmental activity, so that you got informed intermediary who can help the consumer better. India is probably the best example of technology adoption in one area in securities markets, and that is dematerialization of shares. In the second half of the 1990s decade, in a very short period of time, we moved from 100% physical securities to almost 99% electronic securities or dematerialized securities. That was among the fastest shift from paper to electronic. And that's not just one example. Today, many processes are automated with good use of technology to ensure that the consumer experience becomes better, convenience increases, cost efficiency improves, transactions happen seamlessly. But over and above that, technology is also used extensively for monitoring and for all the protective measures that we talked about. How can you figure out whether a price rigging takes place or not? How can you figure out whether there is an insider trading or not? Once again, technology comes to help. There are system level checks. There are softwares and processes built into the system where it is easy to identify some of the cases for further scrutiny. Sometime back, we saw the arrival of silver exchange traded funds. Before that, we saw REITs and InvITs, real estate investment trusts and infrastructure investment trusts. Quite new products which were introduced in the market. These are just some of the examples. There have been many more. Entire new business has been brought up called alternative investment funds, AIFs. And this is maybe a couple of decade story where these new products have come in. With the use of technology, a lot of innovations are taking place and they eventually help the markets develop further. And then comes the third category of functions, regulatory in nature. The intermediary that is trying to do business in the securities markets must be registered with SEBI. Now, this registration also involves certification. So, certification is mandatory for the purpose of registration. So, to that extent, the functions could be linked, but unregistered entities are not allowed to operate in the securities markets. For all the intermediaries registered with SEBI, they have to follow certain processes, certain way they can conduct their operations, certain things they are not allowed to do. And of course, the intermediaries and market infrastructure institutions like stock exchange, they have to conduct their operations as laid out in the regulations. These are the functions of SEBI: protective, developmental and regulatory. The third regulator, IRDAI, Insurance Regulatory and Development Authority of India. As we saw in case of RBI and SEBI, IRDAI also, the primary objective is protecting the interests of the policy holders. The people who buy insurance policies, they are called the policy holders, and their interests must be protected. For that purpose, the insurance companies and insurance industries have to either get registered or they are licensed, but eventually both are regulated by the IRDAI. So, IRDAI issues regulations and also does checks or audits on whether these regulations are followed regularly or not. Insurance is a very long-term business, especially the life insurance. insurance also is a very responsible business, because somebody has bought an insurance policy in order to cover various risks that they can face in life. And at that time of that risk, the insurance company is supposed to compensate for the loss or reimbursement, or provide the promised benefit. So it's a different kind of a promise that has to be fulfilled by the insurance company when the consumer is probably in an emotionally disturbed state of mind. Let's take some examples. Life insurance. The claim arises at the time of death of the person whose life is insured, and obviously the family members are not in the right state of mind. Medical insurance. The claim arises when somebody in the family is hospitalized. Fire insurance. The claim arises when the property is affected in some shape and form, damaged or probably completely destroyed on account of fire. The claim actually arises when there is a negative outcome. At that point in time, will the insurance company deal with the consumer in a professional and empathetic manner? And that's where IRDAI promotes professionalism in the insurance industry. The non-life insurance business, the health insurance, fire insurance, property insurance, motor vehicle insurance, in these policies, the claim is paid as a reimbursement of certain expenses or the damages that have happened. And in such cases, how much money is collected by the insurance company as premium with respect to the amount of insurance cover? This should be reasonably cheaper for the consumer to buy, but it can't be so cheap that the insurance company completely loses out. It's not sustainable for the insurance industry. And that is where IRDAI ensures that the premium rates on these policies, the terms and conditions of these policies are such that the consumer doesn't lose and the insurance companies can survive and thrive in the business. The IRDAI also specifies the financial reporting norms for the insurance companies so that, first of all, the regulator can properly monitor the functioning of these companies. But at the same time, for an insured, the customer of the insurance company, to take an informed decision about buying insurance policy, these reporting norms would help access sufficient information. The insurance coverage in rural areas and the vulnerable sections of the society has always been a pain point for the government. The financial inclusion must take care of the basic protection, and this basic protection comes from insurance business. If the rural India, if the vulnerable sections of society are not adequately insured, they are most susceptible to lose their livelihood. They are most susceptible to lose whatever little wealth they may have or all the wealth they may have in the absence of an insurance policy when the calamity strikes, when the tragedy strikes. And that's why you call it a developmental function of IRDAI. IRDAI ensures that the vulnerable sections and the rural sections of the country get sufficient insurance coverage. In fact, very recently, some of the schemes which were launched by the government towards providing basic life insurance and basic health insurance. During COVID-19 also, a couple of policies were issued to take care of basic expenses related to the pandemic. And those were largely aimed at this segment. While the consumer's interests are taken care of, the insurance companies must remain solvent. They must have adequate, so that while protecting the consumers in their bad times, the insurance company doesn't turn bad. And these solvency margins are nothing but adequate capital, ensuring the insurance liability to the capital ratio, ensuring that sufficient money is invested in the safer places so that the capital loss does not happen, at least on that part of the portfolio, while taking certain risk on some of the other part of the portfolio. Life insurance companies in particular, and also some of the general insurance companies, they have large sums of money that they have received in form of insurance premium that their consumers have paid. Now, till the time the claims don't come, that money needs to be invested. And those investments need to be done in a prudent manner. While the insurance company is investing the money, that corpus is meant to service the insurance policies that the policyholders have bought. And from that point of view, it is important that prudent norms are followed while investing the policyholders' funds. In one of the earlier chapters, we discussed about the reforms in the pension sector, when the entire pension system was moved from defined benefit to defined contribution, and that marked the birth of what was known as new pension system in those days, NPS, and currently known as the National Pension System. And this National Pension System is a product where on a regular basis, to begin with employees of companies, and then now it's available for other individuals as well, they contribute to this corpus, and that corpus, depending on the value that they grow to, the money grows to, would be utilized by these people for their own retirement funding. This NPS has been in existence for more than a couple of decades now. PFRDA was set up to ensure regulation of these pension products, primarily NPS. Their mandate is to promote old age income security. Old age income is nothing but the pension. How do the consumers get their regular income during their years of retirement? By establishing, developing and regulating pension funds. The pension funds are the ones that invest the consumer's money. They manage the consumer's money, and that entire system is called NPS. It is also mandated to protect the interests of the, in this case, the consumers are called subscribers to the pension funds. Once again, the interests of consumer needs to be protected. PFRDA is responsible to regulate, promote and ensure orderly growth of NPS and other such schemes. Regulate, promote and ensure orderly growth. As you can see across the four regulators, the objectives are clearly aligned with these three words: protect the consumer. Number 2, promote the growth. Number 3, but in an orderly manner. One of the very important aspects of the regulatory system, regulatory regime, is to define the rights of the consumer as well as to lay down the process for redressal of their grievances. In case of the consumer having any grievance with the service provider, how do these grievances be handled, addressed and resolved? What is the procedure that the consumer must follow? What are the documents that the consumer must submit? And what is the approximate timeline within which one should expect a resolution? In the absence of the service provider taking any action, in the absence of the timely and satisfactory resolution, what action or what course of action is available with the consumer? That's where the grievance redress mechanism becomes very important. Let's start with the grievance redress mechanism followed by the Reserve Bank of India, and we'll look at all the 4 regulators one after the other. First of all, one must lodge the complaint with the respective bank or any entity that one is dealing with. This can be done in multiple ways. One can send an email, one can go to the branch of the bank and give the complaint in writing, one can send the complaint by visiting the website of the bank or the agency, or there are customer care numbers, there are toll-free numbers, one can call up and lodge a complaint. Once the complaint is lodged, the consumer is supposed to wait for a maximum of 30 days. The bank may respond much before that, but if the bank does not respond within that period, then one has to move to step number 2. And this step number 2 is all about approaching what they call the banking ombudsman. A banking ombudsman system is sort of a higher level authority with some amount of power to issue guidance or even give instructions to the banks to resolve the consumer grievance. There are quite a few officers, senior officers who are appointed as banking ombudsmen, and they are spread across the country. The details are available on the website of the RBI. So as a consumer, if you are not satisfied with the resolution that the bank has given, or if the bank has not given a resolution, or the bank has not acted at all, within 30 days, you to approach the ombudsman. Somebody often asks this question, yeah, I know I have to go to the ombudsman, but where do I get the details from? So this is the URL of the website of RBI. In order to ensure transparency, these details are easily accessible for everybody. What the ombudsman does is to offer a settlement between the two parties, and this settlement importantly is legally binding to both the parties. Having said that, like in case of courts also, when a lower court gives a decision which is legal in nature, the aggrieved party has the right to go to the higher court. Exactly in a similar manner, one may go to the RBI also. However, if the agreeable settlement is not possible, mutually agreeable settlement is not possible, then the ombudsman is also authorized to pass an order, and this order or a decision becomes binding to both the parties. And this order is generally passed based on the facts submitted, based on the documents submitted by both the parties, and that's how the resolution is arrived at. But as you said, if that resolution is also not acceptable, then the consumer can go to the appellate authority, appeal to the appellate authority within a specified time period. This is also called taking the legal route. The appellate authority is generally the deputy governor with Reserve Bank of India. So you can actually see the entire escalation matrix. First you go to the service provider, if not go to the ombudsman, if not go to the appellate authority. The banking ombudsman system has senior officials being appointed as the ombudsman across 20 different geographical locations, and as we just saw, the address can be accessed through the RBI website. Now this number may go up over a period of time as the system develops, the penetration of banking also goes up. So one may need to keep checking the website depending on which area you belong to, because these ombudsmen are covering all states and union territories. This is free of cost to the consumer. So the consumer doesn't have to pay any cost, and that's logical also, because first of all, I was expecting my bank to provide certain service to me. The bank is in business of providing that service to me. They have failed to provide that service to me, and now with the grievance, if I approach somebody, well, I don't expect to pay, and that's why this facility is available free of cost. There are various grounds on which the complaints are classified, and they technically covered almost every aspect of banking and financial services. Each bank is also supposed to maintain what they call the Charter of Customer Rights. And as you can see, these are quite not just obvious, but very important points, very important factors. Every banking consumer has a right to fair treatment. Every banking customer has right to transparency. And what does transparency or fair treatment, and of course fair and honest dealing, mean? If I am taking a loan from the bank, do I have the right to know the interest rate? How does it work? That's only fair. That information must be available transparently. The right to suitability. If something is not suitable for me, then nobody should be forcing to sell it to me. My data is private data, and bank is not allowed to share that data with other entities other than the government or the regulatory agencies. And I also have the right to grievance redress, and as a part of that grievance redress, if there is any compensation due, then I also have the right to that compensation as a consumer of the bank. This charter, is called the Charter of Customer Rights. Well, RBI has a detailed mechanism. SEBI also has their own, sets of processes. Within SEBI, there are multiple entities, and those multiple entities can be accessed in form of registration of a complaint through a portal that SEBI has created called scores. Scores is an acronym SCORES, SEBI Complaint Redress System. Any grievance against any issuer or intermediary can be lodged on the scores portal. The complaints can be lodged online or offline. And once the complaint is lodged and one has got the complaint number and the registration on the website, so which would mean the login ID and password, one can view the progress, which means from where to where the complaint has moved, as well as what responses the respective entity, issuer, intermediary has given. So all these things can be viewed online in a transparent manner, and you can see this progress. Now, progress is important because if I am supposed to receive a reply from, let's say there is a registrar of companies and where I have lodged a complaint for non-receipt of something, are they responding or resolving in the stipulated time or not? That can be easily seen when I have this facility called scores. What are the typical issues? Typical complaints? When it's about the issuer, it is typically about issue of securities, transfer of securities. It's about non-receipt of dividends or other corporate benefits. It's about pending dematerialization of physical certificates. Various issues may be covered here. And when it comes to intermediaries, any lapse in the promised service or any delays beyond the defined timelines. Take for example, when you are dealing with a mutual fund, you invested in the new fund offer, you are supposed to get the allotment of the units and the account statement within a time period specified under SEBI regulations. If you bought shares through a stockbroker, after you made the payment, you are supposed to receive the delivery of shares in your demat account within a certain specified time period. If you don't, you can easily go and approach the scores portal, register a complaint over there. SEBI says that first approach the company or intermediary and try to get it resolved there. However, if the resolution is either delayed or not satisfactory, then through scores you approach SEBI. So it's a simple two-step process. And as we saw earlier, the complaints progress can be viewed online. The insurance regulator has also acted in a wonderful manner by developing a system what they call IGMS, Integrated Grievance Management System. It's for the insurance policy holders who have grievances. Once again, they are advised to go to the company first. If the company does not resolve the complaint, or if the resolution is not satisfactory, then consumer can or the policyholder can go to IGMS. It provides an online gateway to register the complaints. Like in case of banks, insurance industry also has the ombudsman scheme. The individual policy holders are the beneficiaries of this scheme. This is a cost-effective out-of-court settlement system, and it is impartial, efficient and cost-effective. It's quite similar to the banking system, where once you approach the insurance company, you either not received any resolution or the resolution is not to your satisfaction, then you approach the ombudsman. The time period once again is 30 days like in case of banking system. Any policy that you taken in your capacity as an individual is eligible for this particular scheme. However, there is a limit. The total claim, the value of claim, including expenses, should be less than 20 lakh rupees. Otherwise, if the amount is larger, then the scheme is not available. Well, the resolution of your claim also, the repudiation of claim also is important. If the full claim is not given or no claim is given, which means a partial settlement is given in case of an insurance claim, then one can approach the ombudsman, because while my policy covered expenses up to, let's say, 10 lakhs in case of a medical insurance policy, the insurance company decides that no, we can only pay up to, let's say, 7 lakhs or 8 lakhs, though the total expenses incurred were 11 lakhs. And there could be whatever reason. In such a case, if the consumer is aggrieved, the consumer doesn't get a proper response from the insurance company, then one can always approach the ombudsman. Any dispute about any premium already paid or it is payable and there is a grievance about it, then one can approach the ombudsman. Any dispute with respect to the way the insurance contract is drafted, if there are any areas where there is an issue, one can approach the ombudsman. Any delay in settlement and any document, the policy document, if you not received within due period after paying the premium, all these cases are eligible where a consumer can go to the ombudsman. The settlement process is quite simple. They first act as a counselor and a mediator and try to arrive at a fair recommendation based on the facts of the dispute. So the ombudsman calls both the parties for hearing, takes their respective positions, collects the documents, collects the data through interview, asking questions, and based on that and after doing a proper fact checking, they try to arrive at a fair recommendation. If both the parties agree, then they will inform the insurance company and the company will have to act in 15 days. The award typically is passed when the settlement recommendation that the insurance ombudsman has given is not working. The time period in this case is 3 months of receiving the complaint. It would be binding to the insurance company, and this is a very important point. It will be binding on the insurance company but not binding on the policy holder. And this is where the regulations come in handy. The aim is to protect the interests of the consumer, the policy holder in this particular case. the award also has to be accepted in 15 days and the insurance company must act within 15 days. So the timeline is also clearly defined in this case. What the PFRDA does is, in case of any grievance, there are the central record keeping agencies through which the complaint could be lodged. One can also go to certain officers to file the complaint in the central grievance management system. Of course, there are certain forms also that can be filled up if one doesn't want to go online and offline once somebody wants to register a complaint. Now, from grievance redress, let's come to another area which remains unregulated. While the regulators have tried to cover as much as possible, there are some areas still left where the regulations do not apply. What happens in such unregulated businesses or with the unregulated entities is that the rules are not standard across the whatever industry it is. Now take for example, if you deal with a stockbroking firm, then the rules are standard as far as the settlement of transaction is concerned. If you buy shares, you to pay in certain number of days, you will get the securities in a certain number of days in your demat account. If you sell, you to deposit the securities in a defined time period and you will get the money in a defined time period. If you have taken a life insurance policy, you get what they call a 15-day free look period. If you are not satisfied within that period, you can surrender the policy, the insurance company must refund the premium paid, no questions asked. These are standard rules that apply across the industry because the regulator has mandated this. What happens in case of unregulated entities is they are unregulated, so there is no regulator, there are no regulation, and that means the rules can be framed by each individual player. Well, the rules may be framed by them, but if they don't follow, in case of a regulated entity, the regulator would ensure that the rules are followed. In the absence of following or complying with those rules, there could be severe consequences, penalties, or cancellation of license. In this case, there is nobody to monitor. So, in case if a consumer has grievances, there is no standardized grievance redress mechanism when the regulator is absent in case of the unregulated entities. And in the absence of the defined grievance redress process, there is no recourse to fall back on, and one may have to get into lengthy court procedures which may take a lot longer time. So, what does the government of India do about it? The government of India aims to reduce the number of entities in the unregulated part of the economy. Two recent examples: the Securities Laws Ordinance 2013 widened the scope, giving more powers to SEBI over a slightly wider scope of various investment products. The second thing that they did was, anybody raising resources by whatever means would be classified under collective investment scheme if it is not regulated otherwise. And there have been a few cases in the past where people have tried to raise resources from gullible public, offering promises which were unreasonable, unrealistic and exorbitant, because the products were not falling under Reserve Bank, IRDAI or SEBI purview. They launched these schemes and eventually the consumer ended up losing money. Now, with this widening of the definition of collective investment scheme, SEBI has got power, and that power would mean any entity who is doing business in this manner without registering with SEBI is actually starting with violation of the law. SEBI has the power to now take actions against such entities, and in such a case, recovery of investors' money becomes a slightly faster process. So from these discussions, it must be clear to all of you that as long as possible, one must avoid dealing with unregulated entities. The corollary to that is one must deal with regulated entities, or when you're looking at financial service providers, the first rule should be to deal with regulated entities within regulated markets. Here is a broad list of what kind of entity that you select as your service provider. If it is basic banking services, bank accounts, fixed deposits, then go to banks. Various loans, while it says bank loans, it could be home loans, education loans, vehicle loans, whatever. You go to banks, non-banking finance companies, housing finance companies. If it is payment services, electronic payment services or otherwise, then you go to the banking system, you go to the electronic and mobile wallet providers. All these are regulated players. So any of these needs, you know which category to go to. If there are investment requirements, whether it is for a short period or a long period, but investments are happening through securities markets. What is securities markets? Whether it is primary market or secondary market, whether you are investing in IPO, bonds, debentures, shares, mutual funds through stock market, or in case of mutual funds outside of stock market. If you are accessing these service providers, there are stock exchanges, stock brokers, mutual funds, investment advisors. Go to them. If you want to open a demat account, you can go to a depository participant, and for a trading account, you deal with a stockbroker. Any insurance policy, be it life insurance, health insurance, other general insurance policies, or you are buying annuity product which provides regular income over a period of time. If you are buying any of these products, then go to the entities registered as insurance companies with IRDAI. You can also go to insurance brokers and take their help. Now, one may say that insurance agents come and sell us policies. So they are not directly registered with IRDAI, but they are registered with the insurance company. They are agents of the insurance company which are regulated by IRDAI. Exactly in a similar manner, if you are dealing with, let's say, a mutual fund distributor, the distributor would be empaneled with the respective mutual fund. They would be registered with the Association of Mutual Funds in India called AMFI, and the mutual funds are regulated by SEBI. If you are looking at a pension product called NPS for accumulating or building a corpus for retirement, NPS is provided by various pension fund companies which are registered with PFRDA. There are retirement advisors registered with PFRDA who can help you select which kind of PMS is suitable for you, which one should you go for, etc., etc. Or you can go to the points of sale and directly buy or get service on your NPS investments. The money that is lying in your savings bank account, the money that you invested with a bank in a fixed deposit, is that safe? If it is, then how is it safe? So first of all, banks are highly regulated entities. They need to maintain certain capital of their own as per the Reserve Bank regulations, which most of the times ensures that the banks are financially healthy. Number two, along with that, there is a provision called deposit insurance, and for that the Government of India also has passed the Deposit Insurance Act. A company under RBI is set up called DICGC, Deposit Insurance and Credit Guarantee Corporation. This entity provides insurance for all the money in bank accounts, be it savings account, be it current account, or be it fixed deposits or recurring deposits. For each individual, up to a certain limit, the amount is insured within a bank. The Act was passed in 1962 because a few large banks they failed, and the government felt, the RBI felt that this could lead to erosion of people's trust in the banking system, and that's how this act came into play. Post that act, a lot has happened. The act was amended in 1968 to also include cooperative banks, while originally it was only meant for scheduled banks. And then the insurance cover has been enhanced over a period of time. Over and above the inclusion of cooperative banks within the purview of Deposit Insurance Act, the amount of insurance also has been increased over the years. While it started at 1500 rupees in 1962, today in 2024, currently it stands at 5 lakh rupees per consumer per bank. Now this per consumer per bank is important to understand. The cover of 5 lakhs is also important for one to understand. Let's say a person has an account with bank A, a savings bank account, and in that account one has, let's say, 1 lakh rupees. This person also has deposits worth, did fixed deposits worth 3 lakh rupees in the same bank. The 1 lakh plus 3 lakhs is 4 lakhs, which is less than 5 lakhs. So the entire balance between the fixed deposit and savings account is covered. However, if a person has, let's say, a business owner, a proprietor, has a current account where one has got 2 lakh rupees, 3 different deposits of 1 lakh each, and savings account balance of 50,000 rupees. So 3 deposits of 1 lakh each, 3 lakhs, 2 lakhs in current account, 5 lakhs, and 50,000 in savings account. So the total amount is 5 lakh 50,000. If something happens to the bank, then this person would get 5 lakh rupees, not 5 lakh 50,000. Look at the other way. If I do a deposit of 4,50,000 in a bank and my interest accrued so far and yet not paid by the bank because it was a cumulative deposit. So far the accrued interest, let's say, is 40,000 rupees. Then that is 4,90,000 rupees. It is within that 5 lakh. However, if I had done a fixed deposit of 4,50,000 and so far I have earned interest income on that, again it is reinvested, and that interest income happened to be 80,000 rupees. Now 4,50,000 plus 80,000 is 5,30,000. In case something happens to the bank, the investor would get 5 lakh rupees, the 30,000 would not come. Now this is per account holder, per bank. If money is split across 2 banks, then with each bank the coverage limit is 5 lakhs. The banks are supposed to ensure that the deposit remains insured. And that's why the question comes, how much is the insurance cover? Number one, who pays the premium and how much is the premium? So first of all, as we just discussed a while ago, the insurance cover is rupees 5 lakhs per depositor per bank. The insurance premium is paid by the bank and not the deposit holder. So it's the duty of the bank to pay the premium. How does the consumer know whether the bank is paying the premium or not? Well, we'll address that in a while. The premium on this insurance is 1/10 of 1% since 2004-05. In other words, for every 100 rupees worth of deposit, the bank has to pay a premium of 10 paisa to DICGC. So long as the bank keeps paying this premium, the money of all the depositors within that bank remain insured. And that's why a few points that every consumer of banking system must know. Number one, DICGC's website, and here is the URL for that. On this particular page, it carries a list of all the commercial banks that have got this insurance cover, and the insurance cover is live, which means the bank has paid the last insurance premium also. So this entire list is available. As we said earlier, deposits in different banks would be insured separately because all the banks would be paying the premium themselves separately, irrespective of who's got single account with a bank or who's got single account with multiple banks or multiple accounts with multiple banks. Deposits held in same capacity and same right in one bank will be insured together. And okay, so here is a small mistake, so let's cover that. The cover is 5 lakhs rupees per bank. And finally, in case of any doubt, one can always go to the Deposit Insurance and Credit Guarantee Corporation. The consumer of the bank can ask the bank for the DICG number. This number can be used to check or to communicate with the DICGC. This entire chapter on regulation is extremely critical for any consumer to understand. First of all, for the protection of consumers in the financial market, which leads to enhanced trust. Regulators play a crucial role. They lay down a few rules, guidelines, regulations, etc. to ensure that the market participants play the game in a fair manner. But at the same time, there is a grievance redress mechanism also clearly laid out. The consumers owe it to themselves to ensure that they deal with regulated entities only.